Hey guys, it's Jake, and in today's video, we'll be talking about my favorite 6 Vanguard ETFs. All these ETFs are super reliable, have a history of giving high returns and low cost. And I'll share why that's super important later on. And I want to give a brief overview on what ETFs are and what the benefits can be. This won't be super in depth because if you want something like that, and it's linked up above and down below. So I recently got into a comment conversation with someone that said that I look like Kurt Cobain with a haircut. I'm not sure what that means. I could just be like a white guy with blonde hair, but you let me know what you think. But I digress. The argument was over, they thought that mutual funds were better than ETFs. For nearly a century, that was the case, as traditional mutual funds were a better option as compared to you picking your own stock portfolio, one stock at a time. And mutual funds do have their benefits as they provide investors broad diversification, professional management, relative low cost, and daily liquidity. However, using ETFs or exchange traded funds, which short version is basically a mutual fund that you can trade throughout the day like a stock, takes the benefits of mutual funds to the next level. While using ETFs, they have a lower operating cost than traditional open-end funds, flexible trading, greater transparency, and even better tax efficiency in taxable accounts. There are some drawbacks to ETFs, and those could be the trading costs or needing to learn about what the products are. But most informed financial experts agree that the pluses outweigh the minuses by a sizable margin. This is information that I got from Fidelity, so you don't have to take my word for it. Back to the comments of the user, and their biggest concern was that with ETFs, you can trade them regularly and the psychology of people will make them sell, while this person will diamond hand their mutual funds. We'll just buy and hold these ETFs and you'll get a better return and take out the biggest negative of ETFs, which is their trading costs. Problem solved. But this isn't financial advice because I'm just some guy that looks like a short-haired Kurt Cobain. So I don't know what to do with that. But that is enough of the intro. Let's actually get into the video. And throughout this video, I will be using footage from my trip to Scotland. The first thing that we need to talk about is the expense ratio. And I feel this is often overlooked and people just ignore it and move past it all willy-nilly. Yes, I did just say willy-nilly. The expense ratio is crucial to understand as it can save you hundreds of thousands of dollars, and I'm not just making that number up. And the expense ratio indicates how much of your investment in a fund will be deducted annually by fees. And the fund's expense ratio equals the fund's operating expenses divided by the average assets of that fund. And here's an example of just how much even 0.01% can make a difference. So let's finally dive into the ETFs. And if you want to fact check my information, I provided links down below, and all of this is current off of the Vanguard website as of May 27, 2022. Fund 6, Vanguard Real Estate ETF, ticker symbol VNQ. So as you likely guessed, VNQ invests in real estate, or more specifically, real estate investment trust or REITs. And if you want more information about that, I do have a video that deep dives into REITs up above and down below. And the goal of this ETF is to closely track the returns of the MSCI US Real Estate 2550 Index, which is an index designed to capture the large, mid, and small cap segments of the real estate market. Fund components typically buy and hold commercial real estate properties. That probably sounded like a bunch of mumbo jumbo, but what that actually means is they invest in commercial real estate properties like hotels, retail space, office buildings all across the US. The VNQ's geographical diversity prevents it from regional economic trends, but if there's a macroeconomic risk, such as a recession, then that's usually bad for the US housing market, which will impact VNQ. VNQ has an expense ratio of 0.12%, a one-year return of 7.81%, a 5-year return of 8.68%, a 10-year return of 8.92%, and Vanguard gives them a risk potential of 4 out of 5. If you would have invested $10,000 in this ETF 10 years ago, your original investment would now be worth $23,500. These are VNQ's holding breakdown, and these are their 10 largest holdings. VNQ is a potential hedge against long-term inflation. According to Morningstar analyst Ryan Jackson, VNQ offers low-cost, no-frills U.S. real estate exposure. VNQ has the highest expense ratio on the list, but when you compare it to other REITs, it's kind of in line with the rest of them. Jackson also says that this ETF's well-diversified, market cap weighted portfolio should be difficult to beat over the long term. This is something that you can invest in if you want exposure to real estate but don't have the down payment to buy a rental property, or you don't even want a rental property for your own. But if you are interested in learning more about REITs, as I mentioned before, and that's up above and down below, or if you'd rather buy your own rental property, I do have a video on that, and that's linked up above and down below as well. But from my perspective, you can find a lower expense ratio with better returns coming up, and that's why you should keep watching this video. Fund number 5, Vanguard S&P 500 Growth ETF, ticker symbol VOOG. Well, it says your fund VOO, make it all the attention, and we will talk about that later on. But the Vanguard ETF Growth Fund has actually outperformed the VOO over the past 10 years. This fund has gone up over 15% as it's focused on growth stocks. The VOOG's expense ratio is 0.10%, a 1-year return of -3.28%, a 5-year return of 16.17%, a 10-year return of 15.12%, and Vanguard gives them a risk rating of 4 out of 5. If you would have invested $10,000 10 years ago, your portfolio would now be worth almost $41,000. These are VOOG's holding breakdowns, and these are their top 10 holdings. Fund number 4, Vanguard Information Technology ETF, ticker symbol VGT. And this ETF is really focused on technology, and as we move forward, I think that we're only going to be more dependent on the use of technology, whether that's computers, phones, the internet. Tech stocks are also highly volatile, which is why Vanguard gives this a risk rating of 5 out of 5. VGT's expense ratio is 0.10%, a 1-year return of -1.76%, a 5-year return of 22.75%, a 10-year return of 18.95%. If you would have invested $10,000 into this ETF 10 years ago, your money would now be worth over $56,000, which means that it's more than quintupled, which is amazing. Because to put that into perspective, comparing that with the standard of VOO or with some of the ETFs that I've listed, that is a huge percentage difference over the course of 10 years. But as I mentioned, and so did Vanguard, this is a very risky stock, so if you have the stomach for it, it can be great to buy and hold. Here are VGT's holding breakdown, and here are their top 10 holdings. Now with the last 3 ETFs, we're gonna change locations because I have a plane to catch, so I will see you guys in Minnesota. So I have made it to Minnesota, and let's finish off those final 3. And if you don't actually believe me and you think that I went through the process of just getting to Minneapolis a little sign to fake all that, I guess here's some proof. But let's dive into fund number 3, Vanguard Growth Index Fund ETF, ticker symbol VUG. So if you like large cap growth stocks like Tesla, Google, Nvidia, and you want to avoid all those old boring stocks like Coca-Cola, then VUG may be right for you. With 50% of the underlying 267 holdings concentrated in the tech sector, VUG is a high risk, high reward play. The ETF can be highly volatile, but you may also see those bursts like you saw from 2019 to 2021. VUG has an expense ratio of 0.04%, a 1-year return of a negative 8.28%, a 5-year return of 16.11%. They have a 10-year return of 14.80%, and Vanguard gives them a risk potential of 4. If you would have invested $10,000 into VUG 10 years ago, your money now would be worth roughly $40,000. The VUG mirrors the performance of the CRSP US Large Cap Growth Index. These are VUG's percentage holdings, and these are their top 10 holdings. Now on to ETF number 2, which is the Vanguard Total Stock Market ETF, ticker symbol VTI. VTI is another super popular ETF, and in terms of performance, it's pretty close to what I have at number 1, and that is because many of the holdings that are in the number 1 ETF are also in VTI. VTI seeks to track the performance of the CRSP Total Market Index, which is an index that tracks a blend of large, mid, and small cap stocks. By investing in VTI, you get exposure to over 4,000 stocks with an incredibly low price. The VTI actually covers almost 99% of the investable US stock market. So if you're bullish on US stocks, this is something that you for sure want to buy and hold as a long-term investor. A VTI is 82% large cap with the top 10 companies making up 25% of its weight, but here are the percentage breakdown of its holdings, the top 10 stocks in VTI. VTI has a gold rating from Morningstar, and their experts project there to be excellent performance in the future. VTI has an expense ratio of 0.03%, a 1-year return of negative 3.31%, a 5-year return of 12.97%, a 10-year return of 13.25%, and Vanguard gives them a potential risk of 4 out of 5. VTI does have a mutual fund option, but you do need to make a minimum purchase of $3,000. Number 1 on the list is the Vanguard S&P 500 ETF, ticker symbol VOO. This is first on my list and on many others, which makes me feel better about it having here at number 1. This specific ETF invests in the S&P 500 index, which means that you're buying shares of something that's going to track the top 500 companies within the US. With only tracking the top 500, you may miss out on some of the low price stocks when they have a run up, but you will also miss out on them when they crash down as well. VOO has become quite volatile, but honestly, what hasn't these days? But here are their percentage holdings, and here are their top 10 holdings. VOO has an expense ratio of 0.03%, a 1-year return of 0.2%, a 5-year return of 13.181%, a 10-year return of 13.64%, and Vanguard gives them a risk potential of 4 out of 5. If you would have invested $10,000 in this ETF 10 years ago, your money would more than tripled, and you would now have over $36,000. So overall, VOO is number 1 on this list because it's easily one of the best ETFs that you can buy and hold as a long-term investor. But you don't have to trust me because, again, I'm just Kurt Cobain with a haircut. But Warren Buffett, you ever heard of him? He advocates for most individual investors to simply buy and hold the S&P 500 index. And if you want to follow his sage advice, VOO is a fund for you. With a 25-year compound annual growth rate of 10%, it still outperforms many active fund managers, which is the benchmark to beat. If I had to choose just one ETF to add to my portfolio, this would be it. For me, I'm okay sacrificing a little bit on the returns, knowing that I'm going to be saving on the expense ratio, because over time, I know how much those expense ratios can really impact your return. And when you're trying to get a better return overall, you tend to be getting into the riskier plays, which is just not something that I want. For me, I prefer the slow and steady long-term approach and making sure that I'm going to be getting a consistent return. But this may not be the right choice for you, which is ultimately up to you to figure out the right plan. But if you know of any which I've left off this list, or you would want to share with me, then please let me know down in the comments, as I'm always looking to improve the way that I'm trying to invest. And even if you disagree with me, then please also leave me a comment, because I like to hear other people's perspective, as I think that's helpful to learn as well. Thanks so much for watching, and if you know anyone that can benefit from this information, then consider sharing this with them. And if you want to help me grow this channel, then please tap that like button. And if you want to be around for when I post my next video, do not forget to subscribe. But I will see you guys next time.